Members, it's time for us to start our meeting. Sorry I was late because I was next door at another meeting. We have 6 members here. The first thing we have to do is to elect a chairman. Well, I think you should invite nominations first. Any nomination? Mr. Ng Leung Seng, do you accept the nomination? Any seconder? Mr. Abraham seconds. So Mr. Ng Leung Seng is nominated. Is there any other nomination? No? No? All right, Mr. Ng Leung Seng, please. Mr. Alan Leung, we just elected a chairman. I know that you're a bit limping today. You can be nominated for the deputy chairman. Is it necessary to elect a deputy chairman? No? All right. Please invite the officials to come in. Welcome, representatives of the administration. We have the following guests from the Hong Kong Monetary Authority. Perhaps I should introduce the representatives from the Financial Services and the Treasury. The Principal Assistant Secretary, Mr. Jackie Liu. From the Hong Kong Monetary Authority, we have the Executive Director, Ms. Karen Kemp. Also from the Hong Kong MA, the Head for Banking Policy, Mr. Richard Chu. And Senior Manager of the Hong Kong MA, Ms. Samantha Yao. From the Department of Justice, we have the Senior Assistant Law Draftsman, Mr. Michael Lam. Government Counsel, Mr. Manuel Ng, and Government Counsel, Ms. Mandy Ng. So welcome all of you to this meeting. This is the subcommittee on 3 pieces of subsidiary legislation, and we're responsible for scrutinizing them. First of all, I invite the government officials to introduce the 3 pieces of subsidiary legislation to us first. Who will do the presentation?
The 3 pieces of subsidiary legislation relating to banking regulation are interrelated. The two shorter pieces bring into force the provisions of the Banking Amendment Ordinance 2012, allowing the Monetary Authority to make rules to prescribe the new Basel III capital standards and add the Multilateral Investment Guarantee Agency into the list of multilateral development banks recognised by the MA, following a similar move by the Basel Committee to recognise MIGA as a multilateral development bank for the purpose of reducing banks' capital charges on exposures to it. The third piece of subsidiary legislation is the more substantive and sets out a set of amendments to the banking capital rules to introduce the new Basel III minimum capital ratios and the new Basel III definition of capital, and to extend the risk coverage of the regulatory capital framework in respect of counterparty credit risk in line with Basel III. Basel III, as members are no doubt aware, is an international standard which draws upon the lessons of the recent global financial crisis to build more resilient banks through higher and better quality capital. The banking industry were consulted globally during the course of the development of Basel III, and as far as the local implementation of Basel III is concerned, the banking industry in Hong Kong has been consulted on several occasions over the past year. The Basel Committee has set an implementation timeline for the introduction of Basel III, which extends over a period of 6 years until 2019, to enable gradual phase-in of the Basel III requirements, strengthening banks' capital and liquidity positions without undue disruption to banks' lending and credit intermediation activities. Under the Basel Committee timetable, the first phase of Basel III implementation, the new minimum risk-weighted ratios, the new definition of capital and the counterparty credit risk enhancements, is due to begin on 1st of January 2013. And accordingly, the Banking Capital Amendment Rules before members prescribe that date as their date of commencement. There will be further rules and rule amendments tabled before the Legislative Council over the next few years until 2019 to introduce the subsequent phases of the Basel III framework in line with the Basel Committee timetable. It is the stated intention of the Monetary Authority and the Financial Services and the Treasury Bureau to adopt and follow the Basel Committee timetable. The Monetary Authority is a member of the Basel Committee. We were invited to join in 2009, and it seems to us appropriate to comply with the Committee's standards, including timeline, in circumstances where there are no compelling reasons not to do so. We are not proposing early adoption of the standards, nor to gold-plate the standards. Our rules are therefore substantively in alignment with Basel III. There are a couple of deductions which are to be made in the calculation of the regulatory capital base, where we are more stringent than Basel III, but our banks already make these deductions under our existing capital framework, so it will not be a change for them, and we consider the existing approach to be preferable to that under Basel III in the light of local circumstances. The Financial Stability Board has recently noted that it is crucial that all jurisdictions redouble their efforts to pass legislation that is consistent with the Basel III framework by the agreed deadline. The Basel Committee is monitoring its members' jurisdiction adoption of Basel III and reporting periodically to the G20 on this. The Basel Committee have also this year commenced an assessment programme, a form of peer review, whereby each jurisdiction's regulations are assessed for their actual level of compliance with the Basel III requirements. So it's not a case of saying, yes, we have Basel III rules in place. The assessment teams will look line by line to see that a jurisdiction's rules are no less stringent than Basel III. The reports produced as a result of these assessments will be published on the Basel Committee's website. Finally, it is probably evident from what I have already said, but the Basel III standards are international minimum standards. Jurisdictions are free to go above the standards, and the approach adopted by other jurisdictions in this regard is something that we will obviously be monitoring. Thank you.
Okay, thank you, Karen. 政府基本上將個
So basically, the administration has given us a brief background of the three pieces of subsidiary legislation, which are interrelated. Basel III is a major international requirement. I'd like to add that for the banking industry, basically, it will adopt international practices by following the timeline. Of course, just like the administration emphasized that we would not implement the requirements in advance of other jurisdictions will follow their timeline only. But regularly, we have to report to G20. Well, it's G20, not G2000. So the banking industry would like to observe international requirements. And now I'd like to listen to members' views on the background and requirements as introduced by the administration just now. Mr. Tian?
Yeah, I mean, if this is an international bank's agreement, Hong Kong will have to abide by it. But I think you mentioned that we're not doing this earlier than other countries. But I had a feeling that in a lot of banks in Europe, they're not going to start in 2013. Like you said, it's going to start at 13 to 19 over a period of 6 years to fully implement this Basel III. But are we now trying to do this through the legislation and have it implemented by when? Or are we saying that we have the legislation ready, but we're not going to implement it yet? Are we doing this ahead of schedule of, say, banks in Spain or Italy? Because the general public's feeling is that a lot of those banks are not in good enough shape today on the capital ratio to actually implement the Basel III as agreed.
M.A.
Thank you, Chairman. The Basel Committee set the timetable, and they set the 1st of January 2013 as the implementation date for the new minimum ratios and the new definition of capital. That has not been changed by the Basel Committee. That remains the timeline. Major Asian jurisdictions such as Japan, Singapore, Australia and the mainland have already issued their rules ready to go into effect on the 1st of January 2013, as have other financial centres such as Switzerland. You are correct that in the EU, probably due to some competing priorities, they are still discussing what they call CRD4, which is their version of Basel III. I think they produced 3 different versions of it, one by the European Commission, one by the European Council, and one by the Parliament. And at the moment they're in what they call a trialogue, which is a 3-way discussion to sort of conform the language of that CRD4 directive. I think they were meeting on it on the 23rd, 24th October, and they're due to meet again in November. I mean, we're now into November, so I think it's not unlikely that there will be some delay in Europe. I think the intention is still to get a sort of political agreement on it by the end of this year, but it's difficult to get agreement at the end of this year and then introduce it immediately on the 1st of January. But that is a European issue with a European problem. The Basel Committee remain committed to the 1st of January 2013.
Chairman, if that's the case, I'd like to ask that for local bank versus international bank, or international bank that's based in, let's say, Europe, if we have this law enacted in Hong Kong, will we be implementing them at the same time for a local bank of Hong Kong versus a subsidiary of, say, a Spanish bank or Italian bank that has a branch that's in business in Hong Kong? If they cannot abide by that, would they be at a disadvantage?
We will, local banks that are incorporated here and subsidiaries that are incorporated here of global groups will be subject to the Basel III rules here with effect from the 1st of January. We don't set capital rules for branches. No.
Okay.
So the branch will be set from its home jurisdiction.
Oh, I see. I didn't realize that. Okay. And the last question is that for the average child on the street, what does that mean? Does that mean that the borrowing costs for all businesses, whether they are conglomerates or SMEs, is it likely to go up in the sense of not the HIBOR, but the HIBOR plus the margin will go up because the banks will have to put more into the capital versus the loan ratio?
Well, actually, banks in Hong Kong are already very well capitalised. They already hold buffers in excess of the minimum requirements. So the cost of holding this additional capital is not new to them. The average capital adequacy ratio at the end of June was 15.9%. With a Tier 1 capital ratio of 13%. And of that Tier 1 ratio, about 89% is Common Equity Tier 1. So that gives you a sort of 10% roughly Common Equity Tier 1. So they are already in excess of the levels set by Basel III. Even if that were not the case, the whole idea of the 6-year transition period would be to allow banks to move gradually into the standards. So the idea is not to create any sudden increase in banks' capital that would cause them to need to raise charges dramatically.
Chairman, just a last supplement question. That means, as far as practically is concerned in Hong Kong, our banks are well capitalized. So if we implement them in 2013, it will not really affect, especially for general businesses, the cost of borrowing for the general business sector.
Certainly not through this regulation.
Okay, thank you.
What other factors the banks may take into account of it.
Okay. Cindy, you got.
Mr. Sin, thank you, Chairman. Mr. James Tan asked about the possible impact on borrowing cost, and according to MA, it would not be significant, but will that make banks more prudent in providing loans or credits? So although the cost may not increase, it may make it more difficult for businesses to take up borrowings. I don't know whether in any way we can be made aware of the impact. Of course, I'm not particularly asking banks to come here to tell us their views, but this is just an international convention, and banks are required to follow the government's direction. I'd like to know what will be the impact on SMEs and also bank users. Is there any way we can assess the impact on these parties? Emmy?
I think that the price of credit and the availability of credit is actually affected by many factors. I mean, regulation would be one of them, but I mean, competitive pressures may also be sort of a heavy factor weighing in banks' decisions, and as would be relationship issues with their customers. So there's a whole variety of issues that might come into the mix. And I think with something like Basel III, you have to balance against the cost factor that it actually does bring some benefits. So investors, for instance, will expect the banks to comply with Basel III, and to the extent the banks do so, they may receive lower costs of funding, lower costs of capital, because they will be perceived to be safer. So the view of investors and the view of other regulators on banks is another factor that we need to balance. So what we're trying to do, I think, with Basel III is a balanced framework that bolsters bank resilience whilst not inhibiting banks' sustainable lending, sustainable contribution to economic development.
I understand that Basel III may or might bring in some benefits to the banks, the investors, but my questions in particular relate to the user size, which include the SMEs in Hong Kong, and also, the general public or the potential borrowers. I think my question is specific. I understand you may have brought in some good size, but, what is the downside? What are the impacts in particular for the users, for the consumers, for example, particularly, there are hundreds or thousands of SME who have to borrow money from the bank.
As I mentioned, the banks are already holding this capital. They are already well capitalised, so there is no reason to assume that their behaviour will change markedly under Basel III. They're holding these buffers at the moment, so the cost of that is something that they are already bearing.
So you assume, or your logic is, there shouldn't be any impact?
Yes, on the basis that the Basel III ratios are already, generally speaking, met by the banks in Hong Kong.
Actually, thanks for the question. So actually, one of the main objectives of Basel III is to increase the resilience of banks and the banking sector, and in such a way they will be able to absorb losses eventually. So the objective is that bank will be able to continue lending to the real economy and the enterprises within which, including SMEs, not only at good times and also at bad times. So in such a way, actually, Basel III is beneficial to the general real economy, including the SMEs.
政府就
So the administration has given us its views on this subject, but I think there's been almost 3 years of preparation for banks, and banks have set up Basel Convention Working Group on the advice of Hong Kong MA. Individual banks will study how they can follow the requirements. As far as I know, the Hong Kong Association of Banks have also reminded banks, and banks have considered whether it would be more difficult to offer borrowings and also the impact on costs. I think banks can certainly fulfill the requirements. So I think in the short term, there will not be immense increase in costs or will not bring risks to SMEs borrowings. But of course, if many banks are not able to fulfill the requirements, then they might have to increase their capital adequacy, capital. And I understand some banks are issuing shares to investors to increase their capital, and I believe this will be a potential trend. I'd like to ask the administration, either the MA or the Bureau, whether from a supervisor's point of view or regulator's point of view, the banks will be able to fulfill the requirement. Will banks be required to increase their capital, or does the administration think that most banks will be able to fulfill that requirement? I'll make a simple supplement and I invite Hong Kong MA to elaborate. As you said, Chairman, banks are very well capitalized in Asia, and we do not see the need for banks to raise capital to comply with with Basel III, and I will fail to see how the borrowing policies would be affected come the 1st of January 2013. And when Hong Kong MA has a very close liaison with Hong Kong Association of Banks, and we believe that the requirements will only have minimum impact on the industry as well as SMEs. I think Hong Kong MA can supplement. Well, you can supplement. Tell us whether you have received a negative responses in terms of public consultation. Is there the need for another round of public consultation from Hong Kong MA's point of view?
We began consulting the banks in January, and I think we consulted again in June and again in August on the actual text of the rules. On each occasion we received a variety of comments from the Hong Kong Association of Banks, and we have responded to all of those comments. We have accommodated several requests from the banks where they felt that we were gold plating Basel III, we were moving beyond Basel III, and as I mentioned, we moved back into alignment with Basel III at the request of those banks. There are one or two areas where, as I mentioned in my introductory remarks, we believe that we should stay with our existing approach, and I think that we've covered all of the comments that the banks raised. Is there anything you'd like to add?
Mr. Tian.
The majority of our banks are in good shape in the sense that even without the Basel III, they are probably up to the standard of what Basel III requires. But I think the chairman asked a question is that during your consultation period, other than the Hong Kong Association of Banks, are there any individual banks that say that, hey, they will have to increase their capital in due course to meet this requirement? Or are you saying with all the consultation that you have met, actually very few or actually no bank will have to increase their capital to meet this requirement?
Some banks may need to adjust their capital mix to meet the new requirements, where we have the 3 new ratios. So you have a common equity tier 1 ratio. So some items that were previously counted as core capital will not fit within that common equity tier 1 ratio. So some banks will adjust their capital mix over time. But I think that we talk to all of the banks about their capital planning processes, and so we don't anticipate that is going to cause a problem. They've seen this coming for several years, and they've positioned themselves to be able to do this.
Thanks. So in addition to consultation that Karen's just mentioned, we also have been doing half-yearly qualitative impact studies on a sample of banks that include large banks and also the small and medium-sized banks in a sample for around 2 years. So based on our latest assessment, none of the banks will have any problem meeting the minimum Basel III requirements come 2013.
Okay. 好，咁就如果對呢部
If members have no further comments on this, I think we have to consider the legislative timetable. Well, the deadline will expire on the 21st of November, that is this month. And any amendment to amend the subsidization, the notice will have to be given by the 14th. And then to move any amendment, the deadline for notice will be the 16th of November. I believe the government's lawyer should have to go through the details of the rules with us. I've checked with the Hong Kong AB, and they have said that there is no need for them to make submissions to this subcommittee. So I believe it will be okay for this subcommittee to vet the regulations or rules, and if need be, the Hong Kong AB can approach us or the administration. Mr. Tian. Chairman, I don't know what other members feel, but perhaps although you've asked the banking industry to see whether they have any submissions for us, well, they may not need to see us, but I would like to meet with them, to discuss with them, and to know their views. Well, Chairman, you said that you have discussed with the HKAB. They are not worried about this? Well, as I said, they have set up a working group. Individual banks have set up their own working groups, and they've been working for almost 2 years. In principle, they don't have major problem with the current capital adequacy ratio requirements, and they do not plan to amend the regulations. But of course, they would like to monitor the actual operation of the rules. For foreign banks, it's okay, but there might be banks affected by their own jurisdictions, and I think it will be for the administration to monitor the changes. In Hong Kong, Hong Kong AB is of the view that they don't see any major need to meet us. But do we want to invite them to come? We can ask Hong Kong MA to approach the Hong Kong AB to see whether they would like to meet with us here. But as the representative of the banking sector, I've already asked HSBC, the current chairman of the HKAB. I can say that they do not think it is necessary for them to come to this subcommittee. I'll give the floor to Mr. Liu first, to be followed by Mr. Sin. I can supplement. When we set up the rules, Banking Capital Amendment Rule 2017, under Section 97C, the Monetary Authority has to consult the FS and also the Banking Advisory Committee, the Deposit-Taking Advisory Committee, the Hong Kong HAB, and the Hong Kong Restricted License Bank Association before they can set up. They can draft this legislation.
We had several rounds of meetings and correspondence with them. Sometimes after our colleagues in the DOJ drafted the legislations, the drafts were actually submitted to the HCAP as well as the Deposit-Taking Companies Advisory Committee and so forth for comment. And that took a year. The HCAP has been very helpful in the process. It offered us a great deal of helpful advice to our Bureau and the DOJ. We've actually accepted their suggestions, so I think consultation is adequate. Is it necessary to go through the documents, pass to the HCAP for consultation, such that we feel comfortable that consultation is adequate? Perhaps you can ask the HCAP for the latest situation. Can we have black and white documents? I think we can ask the HCAP to give a brief written reply to the chairman and the subcommittee to indicate that they've been duly consulted. Yes, I think that's safer. Mr. Sin Chung Kai and then Mr. Abraham Sheikh. Mr. Chairman, I don't mind doing that, but I believe it should be the subcommittee that writes to the major bodies for consultation, because it is this subcommittee that is scrutinizing the legislations. As James raised that, I think as the subcommittee is scrutinizing the subsidiary legislations, it should be the subcommittee asking them directly for comments. All right, then the Secretariat will send a letter to the HCAP. Well, not just the HCAP, the other bodies as well. Yes, we'll write formally to these bodies to consult them formally. Mr. Abraham Sheikh, Mr. Chairman, I'd like to thank Mr. James Tian for raising those concerns. Now, this is a basic duty, that is to scrutinize legislations. Therefore, the electrical brief from the administration is actually not enough. We're not rubber stamps. Members would like to ask questions. With such a simple paper, members will suspect that they might not have done enough. I think they should complete the due process. Procedurally, we should get it right as well. So in future, the administration's paper should be clearer. If they want us to enact the legislations and endorse their documents, then the information therein must be sufficient enough for members to fulfill their duties. And we have to be very careful in scrutinizing any piece of legislation. So I agree with Mr. Sin Chung Kai that it should be the subcommittee writing to the bodies. So, Chairman, thank you for your able leadership. It's not that we don't trust you, but we would like to fully fulfill our duties. Because sometimes administration pressurizes the banking sector into saying yes. So we would like to see whether there are objecting views. It's not that we want to hear objecting views, but we would like to ascertain whether or not there's objection. If so, what are the justifications? Administration, any comment? Well, no special supplement, Mr. Chairman. In fact, in the LegCo brief, we've already set out our justifications for the legislations, and in the part about public consultation, we set out what we've done in terms of public consultation. If members want more information, we're very happy to provide them. Well, our members are very conscientious. We have to complete the procedures. Now, these legislations involve huge public interests. It also affects Hong Kong's status as an international banking center. With the new requirements, will SMEs be affected in terms of borrowing, for example? Will there be any change? So, the LegCo must serve as a gatekeeper. So we have to go through the whole set of procedures and understand everything from the administration. As for the concrete timetable for scrutiny, I'd like to seek your views. The Secretariat has come up with 2 time slots for our next meeting. The first one is the 13th of November, 10:45 a.m. to 12:45 p.m. Another time slot is the 16th of November, is a Friday, from 8:30 a.m. to 10:30 a.m. So altogether, 2 time slots are available. What about the 13th of November? When? 10:45 a.m. to 12:45 p.m. For Friday is an early time slot, 8:30 a.m. to 10:30 a.m. Mr. Chairman, have they checked whether these time slots clash with other meetings? I don't think so. I don't think there's any clash. Well, originally I am to lead a tour of LegCo. Well, I will change that. What about Friday, 8:30 a.m.? It's only at 10-something that there will be several panel meetings. So if there's no extension of our meeting, then it should be all right. Mr. Chairman, I'm not available on the 13th of November. So you prefer the 16th of November, an early meeting starting 8:30 a.m. Well, I don't like 8:30 a.m. meetings, but I have another engagement on Tuesday. Any other suggestions? Mr. Tian prefers the 16th. What about the other members? All right, then we choose the second time slot, Friday the 16th of November from 8:30 a.m. to 10:30 a.m. So that will be the date of our next meeting. We'll go through the 3 pieces of legislation. Well, if we don't mind, we can do part of this today. I'll invite the Government Council to lead us in the scrutiny of the legislations. Who will do that? Well, it's up to the administration which legislation we should start with and who will take us through that. Well, I think we can handle the 2 simpler ones. It's LN 157, Multilateral Development Bank Notice. It's just 1 page. That is, in the notice, we are to add mega. So it's very simple. I believe the Secretariat has already distributed the paper to you. So we only add in the guarantor, the Multilateral Investment Guarantee Agency. That is the Multilateral Investment Guarantee Agency. It's an agency under the Royal Bank. So this agency will be added purely to comply with the latest decision of the Basel Committee. This is a technical amendment. There won't be any change in terms of policy. So if members do not have major views, I will invite members to scrutinize the commencement notice as well. Banking Amendment Ordinance 2012, commencement notice 2012. That is the notice on the commencement date, which is to be determined by the Secretary for Financial Services and the Treasury. It will be the 1st of January 2013. As the commencement date of the Banking Amendment Ordinance 2012. So this is a commencement notice which is rather simple. I don't think there are any drafting problems. Well, after handling these two simple pieces of subsidiary legislation, Mr. Tian, what about the Chinese version? I don't think we have the translation. Well, on the left of page 001. Well, A, B, they know Chinese. C, 亞洲發展銀行 in the Chinese version. And then N. For N, we have Chinese. The English one is very straightforward. I understand the English version fully. Is it that the Chinese version is not printed out? Well, it does not have a Chinese version. It does not have a Chinese version. Administration? I see that AB is International Bank of Construction and Development. C, Asia Development Bank with a Chinese translation. A to M should originally be Chinese. Well, if there is a Chinese name, they'll use the Chinese name directly. If there's no Chinese name, then they won't provide any Chinese version. So you are correct. Even in the Chinese version, they're copying the English names only. So only 2 institutions have a Chinese name. Yes, our understanding is the same. So for the International Finance Facility for Immunization, 多邊投資擔保機構 is the formal Chinese, right? Well, the English version is International Finance Facility for Immunization. 多邊投資擔保機構 is the Chinese version. So only C and N have a Chinese name. The others don't have a Chinese name. And then N, we add in the Multilateral Investment Guarantee Agency. Well, some international organizations have Chinese names as well. Have you checked all of them? Drafting division? Any supplement? Mr. Chairman, every time when we processed these institutions, the institutions are provided by the Hong Kong MA, and usually if there is a Chinese version, they'll provide it to us. So, according to the information here, if there is a Chinese name, then there is a Chinese name. Otherwise, only the English names will be set out. Yes, so we'll only stick to the formal name of the institution. We won't, for the sake of legislation in Hong Kong, that we invent a Chinese name for them. No, we won't invent any Chinese name for them. Yes, I think they've checked the list already. Only those 2 bodies have a Chinese name. Well, it doesn't matter. Just to go back and check again from A to M. Is it still true that most of them don't have a Chinese name? So in the list here, including the latest one, there are only 2 Chinese names. Well, very seldom do we have so few Chinese names. So, well, let us just put a question mark here. Maybe the Hong Kong MA can check again, and next time do give us a reply. Administration? What about the third piece of legislation? It's Banking Capital Amendment Rules 2012. Mr. Chairman, as you said, the rules are rather bulky. So perhaps, Chairman, members, you can give us an instruction on whether or not we should go through the sections one by one, or whether your legal advisor has any question to ask us. And if members have any comment on any provision, we can also provide written supplementary replies. Well, if we are to go through the sections one by one, it may take quite some time. So, Mr. Chairman, I'd like to seek your instruction as to how members would like us to take them through the rules.
Usually, Bills Committee or Subcommittee on Sublet will follow the administration's presentation, and the rules are very technical, and from time to time we might have comments on the policy issues, but of course you can control the pace. If the provisions are rather general, perhaps you can go faster. Mr. James Tian, I agree with you, Chairman, because we have such a big thick bundle of legislation. The administration may want to decide whether it's going to just highlight the important points, or our legal advisor can also assist us to go through the provisions that will help us to save time on insignificant issues. Yes, so please highlight the main issues, and from time to time our legal advisor can point members to important points. All right, it's okay. I will give a very brief introduction, and we'll use the electrical brief as the basis. And when I come to individual provisions, if members have views, feel free to voice out. The Banking Capital Amendment Rules, well, the most important point is to amend the the definition of capital adequacy ratio and requirements. We have amended 3A and 3B to set out that starting from 2013, the 1st of January, there will be 3 latest requirements on the 3 tiers of capital ratio. So you can see from 2013, 14, and 2015 onward. I'll give the floor to the legal advisor first. I suggest that the administration follow the marked up copy, because if we jump from one page to another, it would be hard to follow. But we've just received this document. But this is just a marked up copy of the rules, starting from page 001. So it might be better if we follow this document.
Please just refer to about this. Actually set out in Part 1A of the, which is entitled Capital Adequacy Ratio, and
So the markup copy is in part 3.
43, 0043. Page number 0001. And explain to us the markup, the changes. Sorry, yeah.
即係跟你嘅 page，即係我大家都睇到。
Well, we all see the page number. So you tell us what page you are at, and please tell us the page number. We have just received the marked up copy. I will invite Hong Kong MA to give a brief explanation. If members have views on any provision, do let us know. And if the legal advisor has anything special to voice out, please let us know.
So, right from the first.
嗱，第一頁即係0001頁嗰度啦。
Page is sorry to 00 to page 35 is actually set out the not. Sorry, I need a bit of time to get used to this version. It's just, 43. Oh, yes. To page 43 is actually set out those new definitions that we need to understand in order to interpret the rules contained in the banking capital rules. So some of these are new definitions to incorporated to cater for the Basel III requirements, and some of the definitions are incorporated as a consequential changes to the amendments to the existing banking capital rules, again to reflect the Basel III requirements. And then those definitions will be followed by the new capital adequacy ratios, which is the key part of Basel III that has been referred to earlier by Jackie. So members can refer to, in particular, to Section 3 that is on page 45 that defines the capital adequacy ratio as the three ratios that we have been talking about, the CET1 capital ratio, the T1 capital ratio, and the total capital ratios. And these are the three minimum requirements contained in the Basel III framework. So, and what follows are the level of the ratios that authorized institutions have to comply with in the transitional period that we have been discussing about. So 3A is the transitional the level ratios that applied in the first 2 years of implementation, and 3B is the ratio that we applied from 2015 onwards. As members will know from the electrical brief, the transitional period will run from 2013 to 2019. So these ratios and levels actually reflect the transitional time frame of the Basel III capital standards. And then we come to page 45. Specifies the basis on which authorized institutions have to calculate their capital ratios, because bank may have subsidiaries. So we, as our usual practice, we will require banks to comply with the ratios both on a solo basis, that means the bank alone basis, and also the consolidated basis. So that merely reflect those requirements. So we come to
all right. Although the rules are technical in nature, but let's take a look at page 32. New definitions, page 32. I don't know whether the members of the last term were given explanations of these terms. Additional Tier 1 capital, additional Tier 1 capital instruments and so forth. I think it would be better if you explain these terms to us. Please don't assume that we know them all, because these are new definitions.
So, this part set out the definitions of those new terms. Actually, under Basel III, capital, the regulatory capital of banks are divided into a few tiers. The most the best quality is what we call the common equity capital. That is basically those ordinary shares issued by banks and the retained earnings, reserves, that sort of thing. And then the second tier is the additional tier 1 that members just referred to. So and the third tier is what we call the tier 2 capital. So one of the key focus of the Basel III is to tighten the definition of different tiers of capital, so that the quality of capital is actually higher. So for each tier of capital, we will later specify some criteria that the bank must meet in order for the tier of capital for the capital instruments to be qualified as that tier. So we will have detailed criteria later on when we come to the subsequent part of the rules to define that in quite the detail. Yeah.
Speaker is off mic.
And tier 1.
So tier 1 is the subtotal of CET1 plus additional tier 1. Because the Basel Committee has set the minimum, 3 minimum ratios. The first one is the CET1 ratio, and the second one is the tier 1 ratio, and the third one is the total capital adequacy ratio. So they do not set a ratio requirement at the level of additional tier 1. So tier 1 capital is necessary. That's what, yeah. So actually, tier 1 ratio is CET1 capital plus additional tier 1 capital.
Tier 1 capital ratio includes CET1 capital ratio plus additional CET1.
Yep. Yeah. AT1.
T1.
AT1.
To say that, yeah, okay.
Yeah.
嗰個額外資本呢個。So in 3 and 3A and 3B, you have actually a transition increase in the CET1 ratio and Tier 1 ratio and also total capital ratios.
Yeah, correct.
Okay.
Yeah, correct.
So if you map this requirement on the first day of 2013,
yeah.
So what is the situation of our banks in Hong Kong?
Yeah, they will have no problem. Yeah, based on our half-yearly quantitative impact studies, they will have no problem meeting those minimum requirements.
So they are all above these requirements?
Yeah.
So how about 2014?
2014 is also above, yeah.
So
up to 2015.
So the banks in Hong Kong are already above 3A and 3B also.
Mm.
So they are above, for example, CET1 capital ratios less than 4.5%. So they must be above 4.5, right?
Yeah.
And for Tier 1 capital ratio, they must be above 6 and total capital ratio above 8.
Correct.
Okay. So you said, according to your reportings, all the banks in Hong Kong have already met the requirement up to 2015.
Yeah, that's our assessment. Yeah, that's right.
So we are well capitalized.
Yeah. Yes.
好，所以繼續。
Please go on.
3C, as we've already mentioned, is to specify the basis in which a bank calculates its capital adequacy ratio. So normally for a bank that has subsidiaries, we usually require the bank to calculate those ratios on a consolidated basis and a solo basis. So that is to enable the MA to specify the basis of calculation that actually reflect the existing requirement. That part is actually from the existing banking ordinance. Yeah. So coming to page 46 is just some extra definition to make clear about the interpretation of different terms that used before in section 3, part 1A. Yeah. So, 50. Oh, this is the next. Okay, then we come to page 53. So another elements that we seek to introduce under Basel III is the introduction of an internal model method for the calculation of counterparty credit risk. And section 10A is actually to make available, and members can see here and there the reference to the term IMM-CCR. That is actually what we are just referring to, the internal model method for calculation of the counterparty credit risk approach. Do members have any queries on the IMM-CCR? And that will take us to section is it section 10C? Yes, it's actually page 59, isn't it? 57, sorry. 58 is also on CCR. Yeah, so the introduction of the IMM-CCR framework and those related provisions is going to take us to page 58 of the draft that we have on hand. Okay, next. Yeah. So another new elements that we seek to introduce under the CCR framework is the calculation of credit risk for exposure to CCP. CCP stands for Central Counterparties. And it actually reflects global reform on the OTC derivative markets that banks' exposure to CCPs because of the that will help banks to manage their exposure to CCP and to reduce the risk of their counterparty credit risk exposures. The Basel III framework allows banks' exposures to CCP that are defined as that are qualified as meeting certain requirements. They will allocate lower risk weight to banks' exposure to such CCPs. So for those CCPs that do not qualify based on the specified criteria that we also include in the rules, they will be subject to a higher risk weight. That part is actually reflect those requirements, and that's also part of the enhanced CCR framework that we seek to introduce by the amendment rules. So the next bit is. A83. Okay. So the 83 reflects the consequential revisions to the definition of capital. Because Basel III, in addition to specifying the three new minimum ratios that we've just talked about, they also tightened the definition of capital. So that part actually set out if a bank want to include certain instrument as, for example, common equities Tier 1 capital, additional Tier 1 capital, or Tier 1 capital, or Tier 2 capital, they need to satisfy those criteria specified under this part. So again, that part begins with the relevant terms defined, and as member can see from page 83 through to 86, I guess, 86, yeah. Yeah, and then members can see on the bottom right-hand corner the division 2 is the definition of Tier 1 capital that a member has asked about. That's the definition of Tier 1 capital is the sum of the institutions CET1 capital and the additional Tier 1 capital, and then. And then we go on to what is the characteristics of different tier of capital. And here we will set out individually what sort of criteria an instrument should meet in order to be qualified as under each tier of capital. For instance, in Section 38, that is on page 87, those provisions have to be satisfied in order for an instrument to be qualified as CET1 capital, and then on page 88, that will be followed by additional Tier 1 capital, and what sort of criteria need to be satisfied, and then.
Mr. Chairman, when we formulated the banking capital amendment rules, we did refer to the policy documents of Basel Committee. Therefore, there's not much room for maneuvering. For the Basel Committee, for these provisions on Tier 1 capital, etc., technical documents were duly issued as to what can be deducted, what should be counted as capital, etc. Therefore, in terms of terminology, we have to adhere closely to the documents issued by the Basel Committee, such that other comparable jurisdictions under Basel III will conform with one another. We did have meetings with the Basel Committee, and we've referred all those documents to the DOJ. So there's no question of individual provisions deviating from the Basel Committee's requirement. So it is not we who invented all these provisions. In fact, many of these provisions were directly shadowing those in the documents issued by the Basel Committee. So our colleague is introducing these provisions to you, but I would like to set your mind at ease by saying that these provisions were not invented by us. We did refer to international documents. Our banks and their branches elsewhere will adopt the same set of international standards. Mr. Sin? Well, for the colleagues of the drafting division, are there any major discrepancies between these provisions and those of the Basel Committee? Administration? When we received Basel III, the documents under Basel III, the Hong Kong MA already screened those documents so that we know what to follow. Now, these are rather technical documents, so from the viewpoint of law drafting, we can only compare their provisions with our existing legislations to see whether there are conflicts. And sometimes there are established terminology. Sometimes we're using our own way of drafting, but in terms of content, there's actually nothing to discuss. So can I ask the Hong Kong MA to highlight in their presentation what had been screened, to use the word of Mr. Lam, by Hong Kong MA, because in terms of terminology and language, maybe you need to be more localized. Say, for example, for Section 38 on page 87, or Clause 38 on page 87, can you tell us whether or not this is an exact copying of the corresponding provision in Basel III? So what you want to emphasize is changes or modifications. Now, you're saying that most of your provisions actually follow those of Basel III. So if that's the case, you can just skip them. Mr. Tian, well, I'm on the same issue. I'd like to clarify a few things first. Now, I'm holding this big bulk of banking capital amendment rules. Am I correct to understand that these provisions are more or less the same as those adopted by major international banks elsewhere? Because I shouldn't expect London to give me a different version, Paris to give me another different version, right? So are you telling me that, well, basically these provisions are similar to those adopted by other jurisdictions? So even if I go to a branch in Switzerland, I will see the same provisions, right? As for terms like additional Tier 1 capital, etc., they are adopted globally. So we just use one version. We don't need a special Hong Kong version. If this is the case, then as legislators in Hong Kong will feel more comfortable. Because you're just telling us that we are proceeding concurrently with other jurisdictions, right? So are you telling us that basically this version is more or less identical with the international version?
The simple
Sorry,
question.
I'm a little behind you. Because
Yeah, I know the translation.
Basically, different jurisdictions. The Basel Committee writes Basel III in a certain way, and then different jurisdictions bring it into force in their own jurisdictions, in whichever way suits their legal system. So we put it into place by subsidiary legislation. Others may use guidelines. And in putting it into force in subsidiary legislation, we do use different wording to the extent that it is in legislative format, so that it is different. So we don't track every single word that's in the Basel III document into the legislation. But in terms of, say, common equity tier 1, additional tier 1, those kind of things, we do follow the Basel Committee's listings. So really we're just looking to make changes if there's a better legislative way of saying it. We're not trying to change the substance, but some of the language that perhaps the Basel Committee uses, the bank does nothing. We need to say the authorised institution. So if you expect to see an exact lift, that is not what you would see. But the content, so they have criteria for CET1, they've got 14 of them, we should have all 14 in our criteria.
即係我諗應該可以接受，就係因為嗰個計。
Well, the calculation of the ratios are already prescribed, and there is consistency in the calculation, but as individual terms might differ in different jurisdictions. Regardless of the differences, members would like to know why there are discrepancies. Now, if the requirements are consistent, then a bank in London coming to operate in Hong Kong will have to fulfill these requirements, and a bank from Hong Kong to London will have to fulfill the same requirements. Okay.
We'll continue to invite members to examine individual provisions.
So maybe I just supplement that in terms of as far as the substance or content is concerned, the banking capital rules that we are looking at actually already reflect what is in Basel III. And there are on a few areas that we seek to go a little bit beyond Basel III because of the local circumstances. And maybe when we come to that, we'll highlight for members' attention. Yeah. So for the rest, we just, as we've just mentioned, it's just a matter of language that we use to best reflect the Basel III policy intent. 87, that's section 38 actually sets out what criteria to be satisfied in order for an instrument to be qualified as CET1 capital. And here the lists are fully in line with Basel III requirements. And then section 39, that is on page 88, the additional tier 1 capital, the criteria. And then the third tier, the tier 2 capital, that is on page 90. Yes, likewise is set out the criteria to be satisfied in order for an instrument to be qualified as a tier 2 capital. And up here, I just want to refer also members to a few schedules. That's a few schedules. That is Schedule 4A, 4B, and 4C. And that is in because they are interrelated, and so I think that will facilitate our explanation and members' understanding of the criteria. And maybe we just have a look at page. Is it 40? Yeah, 484. Thanks, Jackie. Yeah, and. So these set out the qualifying criteria to be met in order for the instrument to be qualified as CET1. This Schedule 4A, and then followed by Schedule 4C, that is on page 486. That is Schedule 4B. another newly added schedule to specify what conditions to be satisfied in order for an instrument to be qualified as additional Tier 1 capital. And then Schedule 4C, that is on page, that starts from
494.
494, yeah. That sets out the criteria to be satisfied in order for an instrument to be qualified as Tier 2 capital. Yeah, and then so we go back to the main sections. So we just talked about the Tier 2 capital that will take us to.
May I just ask that, other than the crust, basically is on the Basel Committee. I believe our banking capital rule and our banking capital amendment rule, the schedules, all sort of derived from the financial institutions based on the UK model. So it's not something that HKMA, that we came up ourselves. So may I just ask in a simple way that a lot of these, are they all probably now implemented in sort of London under the UK equivalent authority? So are we moving this over to mirror whatever they're practicing out of the London as an international financial institution on this, or actually we come up with our own ideas on the schedules 4 and 4A?
Those provisions in the schedules mirror what is in Basel III. So the Basel Committee comes up with what it considers to be the criteria for the different tiers of capital to ensure that it's genuinely loss absorbing. And then in London, when they implement the European Union's directive CRD4, they will carry across the same substantive listing. Although, albeit it might be in slightly different language. One point that probably is worth making is, I mentioned in my introduction that the Basel Committee are carrying out assessments. So they will come here. They've gone to the EU, they've gone to the US, and they will do a line by line, and they will issue a report, so that if in any sense you are not compliant, you will get a not compliant, materially not compliant rating.
Karen, then correct me if I'm wrong. So I'm wrong to assume that our whole legislation on this came from the UK in the 80s, 90s. That's wrong. We came up with our own thing under HKMA.
Based upon the Basel.
Okay.
Yeah, so the Basel Committee.
Sorry, not the Basel, the original one, the whole thing that we're looking at.
The original one that you're looking at that's crossed out is Basel II, and that came from the Basel Committee, and that replaced what was Schedule 3 in the banking ordinance, which was Basel I, which came out of the Basel Committee, I think, in about 1988.
Right.
So basically, since about 1988, the capital rules in Hong Kong have more or less faithfully tracked Basel I, then to Basel II.
Sorry, Mr. Chairman, it does mirror the situation in London as the financial capital of the world in those days in the 80s.
Yeah, they adopted Basel I and Basel II, and they will adopt Basel III once the European directive comes into force. Usually, I think Europe issues via a directive, and then the individual jurisdictions put it into their own rule books. CRD4, I think, is a mix of a directive and regulation which will take automatic effect in the jurisdictions. But yes, that they take the European version and put it into their own rule books.
I understand. So that's why all the international banks will have no trouble meeting the requirement of London or Geneva or Hong Kong.
In essence, the more jurisdictions impose this, almost the better for the international banks, because as you point out, they can calculate in their subsidiaries up to the home on the same basis. So it is actually easier for them if all jurisdictions are in line, and more expensive and difficult if we're not.
Okay, thank you. So you will point us to items that are not sort of practiced in those countries, but that's very rare. I think we probably do.
There's just one or two items that we will draw to your attention.
And this will take us to the end of the different tier of capital that is on page 95. So maybe I just pause here for a moment to see if members have any particular question to raise in relation to the different tiers of capital. And then, if not, we'll move on to regulatory deduction. That also has to be taken into account in coming up with the amount of regulatory capital base that,
we won't have many questions or views because we cannot have a view, right? The tier 1 to 3.
Yeah.
It's all done by the Basel Committee. It's being practiced in London, New York. So we just have to go along with it, right?
Okay. Yeah. We will just go. Yeah. Okay. We will just continue. Yeah. So it's on page 95. So there are a number of items that the Basel framework require banks to deduct from their capital base. It's actually broadly divided into two types of items. The first type is those intangibles like goodwill and then other intangible assets and items like deferred tax assets, etc. So these are kind of instruments that are not regarded as being able to absorb losses in the bank should be deducted from the capital base. And the second type of items are what we call that will have a tendency to inflate the capital base in the financial sector, what we termed it double gearing items. That is banks' investment in other financial institutions. Those are also required to be deducted from the capital base of a bank. So this Section 43 deduction from CET1 actually spell out those items. And perhaps there is an idea about, yeah. Oh, okay.
I think here we should draw members' attention to the fact that we have some slight differences in the deductions to the Basel III. The first is in relation to unrealised gains on property revaluation. Basel III will allow unrealised gains on property revaluation to be included in Common Equity Tier 1 without limit. Because of the historic volatility of property in Hong Kong, we are concerned that to allow it to be included in Common Equity Tier 1 without limit would cause the capital base of the banks to be very volatile, which in turn underpins their lending. So if the base is too volatile, the lending may be pulled back in times of if property prices fall. So we prefer to continue with the existing situation, which is that unrealised revaluation gains on property get recognised only in Tier 2, and even there they're subject to a 55% haircut. So you can only recognise 45%, and it's only within Tier 2. So that is a difference from Basel III. The banks are fully aware of this, and we have discussed it with them. But it is the existing method of calculation. The other areas where we're slightly more stringent is that Basel III allows limited recognition of deferred tax assets for timing differences, and it allows limited capitalisation of mortgage servicing rights, where you have sold a portfolio of mortgages, but you receive fees for servicing them. That is not common in Hong Kong, and we have no past experience by which to measure if that is actually a robust form of capital to be included in CET1, so we don't recognise deferred tax assets or mortgage servicing rights. So we are slightly more stringent. Again, the banks are familiar with this because these are already existing deductions.
I assume that unrealised gain is the same as unrealised loss. But if that's the practice, I can believe the Spanish banks could survive if they take into the unrealised loss of the property prices the way they are now in Europe. But they do have this without limit.
Well, that's that you can recognise the gain. This is new under Basel III, so it hasn't come in yet.
I guess gain equals to loss. You cannot just have it for the gain and not the loss.
Yeah, the losses should be recognised, but under Basel III going forward, you will be able to include the gain. We have a sort of asymmetrical treatment under, I think, Basel II, correct, where you take the loss and don't recognise the gain.
Yeah.
But under Basel III, you will be able to recognise the gain.
Yeah.
That's the important thing. So that's the difference, which is what causes us the concern, because it is an unrealised paper gain. One other item I should just mention is that we have included our own anti-avoidance provision, because you are required to deduct, within certain limits, capital investments in other companies. we have put in an anti-avoidance provision so that if you make a loan to a connected company, so it is characterised as a loan, but it is in fact a capital investment, that can be deducted. So it's just to deal with recharacterisation risk.
Mr. Chairman.
May
I suggest, I think, in view of, I think since you just voiced out your, you just clarify the differences between the localization and the Basel III. May I request, if you may, submit a paper to us, detailing, the substantial differences, that how we deviate from Basel III. That will actually satisfy, at least you let this committee know, and that will actually save our time to scrutinize the legislations. I think we focus very much on the deviations. At the end of the day, you said the Basel III committee will come to vet our compliance.
So can you provide the paper? Yes, we can do that after the meeting. At the request of Mr. Sin, I'll tabulate the modifications we've made on the basis of local circumstances. And we can also put in footnotes to inform members what those provisions are. That's to save members time in scrutiny. Yes, you can pinpoint the modified provisions. Yes, then no, we can wait till the next meeting. Thank you very much. So meeting adjourned today. See you on the 16th.